Welcome to this special episode of Develop Your Edge, where I asked 4 of my favorite macro traders what their edge is. Here's what they had to say. Why is it that part of your edge is not just trading the front month contract and focusing on it and maybe in the technical aspect, like you mentioned, you're not a technical trader. Why is it so important to look at spreads and just other things besides just that front month and technicals?
Well, you're very perceptive. You've picked up a lot. Yeah, I know that my edge is not technical trading. And, for so many reasons. I don't have co-located servers, right? I don't have a proprietary chart. That just me being another person looking at uh, a chart that everybody looks at. I'm not bringing anything to the table on that. And when you get into the fundamental realm, where, especially after years and years of seeing the market, you realize that the outright price is irrelevant in a lot of ways.
Interesting.
Obviously, we saw a big swing this year, right? And there are, kind of headline maker prices, but the relationship between either the calendar structure or the spread between being able to move something, either within the US or overseas, the spreads are showing you the marginal unit. And that's what energy is. The price that's trading is, the last molecule, right? It's the last molecule that's clearing, and that's kind of setting the price. And in that way, you can establish timing for expressing something. Natural gas has been a great example this year where people have an expectation of a condition that is going to exist in the future in natural gas based on beliefs about production. And yet there isn't a tightness condition right now in the US. And so you can't really get the market to move. And in that way, I don't care what the price is, that will tell me where I finally move because the condition exists. I care about maybe how a spread might react, regardless of where prices go.
Got
Um,
it.
and I don't know if you want me to go into more detail on that or not,
I,
but
I would like to go into more detail on that. So basically, two things before I let you go. First is, could you just summarize in maybe a few sentences, basically define what you believe your edge is?
um, I think it's having spent years in the industry and understanding relative value and using that to time my trades. And it involves a lot of hard work and constantly digging for more pieces of the puzzle. It's a big, huge puzzle, and I'm always looking at how to put it together. And that's my edge because I do look.
How some of those tweets that you put out end up eventually leading to edges in your trading?
Well, I mean, it kind of my Twitter feed is kind of literally my train of thought or exactly what I'm looking at, and I kind of just put it out there, and then eventually, it a theme will come together that creates a story that will lead me to a market that I want to trade, right? So whether that be at the beginning of the year, with the COVID, and I was looking at the oil markets, and I was seeing all the problems within the oil industry at the time. There were a lot of stories out. I think I did a couple podcasts on how the oil industry was already in trouble. Then this COVID thing started. We started hearing about COVID, for example, and I automatically knew, like, I already had a kind of a short bias on oil already coming into the market, and that was kind of the tipping point for me. So it kind of is, and that was like a month-long kind of process there until I, put it all together and then got short the oil market. So that's kind of, that's more of a longer term trade, but that's kind of how my process kind of works.
Remember, traders, micro treasury yield futures are now live at CME Group. If you think interest rates are going to be on the move, pull up these symbols, 2YY, 5YY, 10Y, and 30Y. To learn more about micro treasury yield futures, go to cmegroup.com. What do you believe your edge is as a trader?
Well, I'm going to quote our buddy Pax, Matt Kenna, and he'll say, because he really put these words into my mind, my edge is the context of markets and the nuance of markets. That's my edge. And why does that, where did I develop that edge? As I talked about when we did with Kashal last year, we talked about it. It's my ability and desire to work. I always believe I'll work anybody because I have to. I don't have a team. I have me and a bunch of, actually the blog was great because I would get so much pushback and feedback, from you, and that all helps. So, but it's creating that context. I understand the context of the markets. I do. That's my strength. And then when there's little bits that show up and I can see the nuance in them, that's my greatest edge in them all.
Well, let's run with that. Where are we right now? What edges are you seeing in the market today?
Well, we did have, really the last podcast we did, I think we talked about the metals, but I've talked about the metals for a long time, and the dollar. And I was telling you that I was a lone wolf out there being as bearish as the dollar as I was. The metals were, of course, performing very well, as we've looked about, always against the other currencies.
Yeah.
But this was now a dollar play, and it was the weakening dollar that took the gold up to its all-time highs. So that was what we saw through nuance. And in fact, I was citing my breakaway from the dollar. My bearishness of the dollar came on May 25th, as I said it, when Wolfgang Schäuble, who's a very powerful voice in Germany, pivoted from being Mr. Nine, Mr. No, as they call him, when it came to fiscal stimulus, and agreeing to create basically a Euro bond and giving out grants to the entire Europe to try to soften the impact of the pandemic. I said, that is a major pivot. And so that's a bit of nuance. That's my nuance. I read that. I had to read it again, and it was Memorial Day weekend. Yep. And I started buying the euro that Monday morning.
And it hit me like a ton of bricks. I'm like, wait a minute. Nobody ever looked at that? Like whatever edge might, and the way I heard that in that moment was, whatever edge might be possible to gain from having insights from the shape of the term structure on the chart and how it might compare to previous term structures that existed before, the whole technical analysis community for all of finance has never bothered to figure that stuff out. That's what you're telling me. That sounds like an incredible opportunity. So I go and I did this interesting Google search where first I Googled Treasury yield curve PhD thesis. And it comes up with like 2,000 pages of search results and a gazillion things. And there's all these guys that did their PhD thesis in grad school on the yield curve. And then they go off to take their proprietary model that the university probably paid them to develop, and they start their hedge fund with it. And I said, okay, let's do crude oil term structure PhD thesis. And it's like nothing, zero. There were matches because Google always finds a match on one of the words in there, but there was nothing that was about that. I'm like, wait a minute, nobody thinks about this? Well, people do think about it quite a bit. Professional crude oil traders, I think, are more engaged in understanding the shape of the term structure and what it means than they are on the flat price, where a lot of retail traders tend to focus. But it's not in the books. You can't find out about this. And it took me quite a long time, actually, because first I started learning chart patterns from my own analysis. I just went through years and years of term structure charts and saying, well, there's this one pattern. I call it a dipsy doodle. That's just the name I made up, where it's like, there's this, because it's what it looks like to me. It's like the beginning of the WTI curve. There's about 3 or 4 months, up to 6 months of contango. Then it rolls off into steep backwardation for about 2 years or so. And then it goes into this much more gradual contango after that. And I call it a dipsy doodle because, and I call the little bit on the left edge of it, right at the front of the curve, I call that the beak because it looks to me like a beak on a bird. It's this funny little hook there. And you see that on the WTI chart, but you never see it on the Brent chart. And it took me years to figure out what the heck, why are they different? Well, the answer is because WTI is a physically delivered contract and Brent is a financially settled contract. And because there's a storage element to it, there's a certain need for the market to price the first few months of the WTI spread into contango in order to allow the guys that are storing oil in Cushing, Oklahoma, to make a buck on that contango yield premium. And if you don't understand what I just said, you can Google these terms and you'll figure it out. But what I learned is, okay, the storage dynamics in Cushing, Oklahoma are different from Brent, which is this financially settled contract based on the North Sea spot price. And that makes this little beak at the front of the curve happen sometimes, but not all the time. And I thought, well, how come sometimes and not all the time? And the other thing I figured out is, wait a minute, these time spreads, they kind of go through a life where for several years, the time spread is kind of brewing farther out on the curve before it gets up to the front close to expiry. And really, at least in WTI, that's mostly about future expectations of supply and demand. Backwardation, when it exists farther out on the curve, means that in that time frame, if we look 2 years out on the curve, we see backwardation there. It means the smartest traders that are putting the bets on in the marketplace think that 2 years out is a time when there's going to be a lot of demand and it's going to be a tight market. The tighter they expect it to be, the more backwardation is there. But even when that backwardation is the dominant theme, if there's a need to pay to store oil in Cushing, Oklahoma, because there's a little bit of short-term surplus, there almost has to be contango just for the first few months. Well, wait a minute. If you know that's going to happen, but not all the time, only when that beak is there on the front of the curve, you can start to say, wait a minute, what if I short those time spreads, not all the way 2 years out, but maybe 1 year out, and kind of sit on them until they get to the front of the curve? Well, that is something a lot of people have figured out, and it kind of works until it blows up in your face. Well, why did it blow up in your face? Well, as soon as you have something like a pipeline spill that affects the physical market, even though it might not have a huge impact on flat price, it's going to blow up those time spreads at the front of the curve to massively high numbers.
Yep.
Well, okay, you can protect against that with calendar spread options. So there's a way to protect that. So I started developing a systematic strategy, which is based on some discretionary analysis, some fundamental analysis of the market, which is what are the factors that cause different parts of the curve to be in backwardation or contango at different times, and what are my expectations about where spreads are going to make that transition to being affected by one factor and then go into being affected by the other factor that puts the opposite pressure on them. It's never 100%, nothing in trading ever is, but there's a substantial edge to understanding the reasons that the back of the curve is affected by different things than the front of the curve. And all of this, by the way, changed completely with the USO ETF blowing up this past year. Because what's happened now is one of the reasons for that contango at the front of the WTI curve was because USO had this ridiculously oversized position in the front month. And not only did they have to roll it every month, but for some reason, nobody can figure out. They advertise on their website. They tell everybody exactly what the date is in advance for when they're going to roll that position. There's all kinds of people that make a fortune front running that.
Yep.
But one of the effects is all those front runners in the market are trying to push the curve into contango there so that they can make a buck front running the USO ETF. When USO changed its positioning, well, we still have contango at the front of the curve, but the change in direction of the curve that used to be very pronounced about 4 to 6 months out on the curve isn't as pronounced as it used to be. And I think that's because of USO shifting its positioning.
If you enjoyed today's episode, give me the thumbs up and hit that like button. If you didn't, give me the thumbs down and tell me why in the comments down below. Never miss an episode of Develop Your Edge. Hit that subscribe button. You could also DM me your questions or comments on Twitter. My DMs are open. At Anthony Crudele on Twitter. And don't forget to check out Instagram. Got a bunch of cool stuff going on Instagram, different from Twitter. At Anthony C. Crudele. That's a wrap for today. See you next week.